Hey everyone, it's Mike from Orderflows, and welcome to today's presentation on using order flow to find price rejection and how to profit from it. And my goal for you today in this presentation is to teach you what is price rejection and show you how to profit from it. I'm going to explain why price rejection allows you to catch trends when they begin, and I'm going to show you how to see price rejection using order flow. Now, for those that don't know who I am, my name is Mike Valtos, and I'm the owner and trader at Orderflows.com. I started it in 2015. Now, the reason why I want you guys to know my background is so that you know that I come from an actual trading background. You know, I wasn't like a college student that just sat in a dorm room reading books and all of a sudden say I figured out the secret to the market. No, this is what I did for a living. And you can see I started on the CME floor as a runner. I literally started at the bottom with Dean Witter. This was in the early 90s. Then when Globex and Project A and NYMEX Access started becoming used by the futures traders on the floor and the desks and the brokerage firms, I left the trading floor and I worked upstairs on the Dean Witter Reynolds upstairs trading desk. Basically, I was the Globex trader. So I did that for 3 years, and I traded literally all the markets that were available on Globex at that time, as well as all the other futures markets that were available overseas. And after that, I left to go to EDF Man, which is the big English trading firm. I spent 2 years there as a global macro trader. After Man, I left and went to work at Commerzbank. I spent 3 years there as a licensed Eurex trader. I traded Bunds, Bobbles, Schatz, DAX, Euro stocks, and I traded all those against the US counterpart products. I spent 4 years at Cargill, the big American privately held trading company, which is actually one of the largest companies in the United States. You know, they account for about 30% of U.S. grain exports, 25% of meat exports, but they literally trade everything you could imagine, you know, energies, interest rates, as well as commodities, and they traded globally as well. And I even went to Singapore to set up a trading desk when the exchange closed in Singapore. When the floor trading closed in Singapore, we needed a upstairs trading desk, and I went out there to set that up. And I spent 8 years as vice president of futures trading at JP Morgan. Now, this was an actual trading job. You know, I spent all day on the trading desk. I'd come in at, 5:30 in the morning, leave at 4:30, 5 o'clock at night. I wasn't sitting in some corner office looking at spreadsheets or anything like that. No, I was on the desk pounding out trades on the system there. So that's my background. So you can understand, this is what I did for a living. This is how I paid my bills and survived, So again, it wasn't something I just did in the part-time. No, this is what I did, as a job, as a career. And what I'm presenting here is what I've developed for myself and built my trading career on. I hope you can find things that you can use or modify and adapt for your own trading. Again, I don't want to think you have to become a clone of me. That's not going to happen, and I don't recommend it, honestly. What you have to do is you take the parts that make sense to you that you can apply in your own trading, and you apply it. Again, I'm not saying that you have to follow what I say just because I say it. You have to evaluate everything you come across, whether it's from me or from other speakers here at Investor Inspiration, and decide if it's going to help you. If not, you reject it and you move on. You find the next thing that's going to help you. Trading is like a puzzle, right? You can't fit, the round peg into the square hole, right? You need the round peg to go into the round hole. And if you're trying to trade in a way that's not compatible with you, you're not going to be very good at it or very successful at it. So let me be clear, with trading, you got to make decisions, right? That's what trading is about. Order flow is not necessarily a red light, green light trading system. Some people like to think it is, but it's not. When you understand order flow, you're going to understand what the market is doing, and your trading decisions are going to become very clear. So before I begin, let me just go through a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and it's not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. The reason why I go through a disclaimer in every presentation is because, I do want you to realize there is risk involved in trading. It's not risk-free. If it was risk-free, everybody would do it, and we'd all be driving around in nice fancy cars and, going to the yacht club or the golf club on the weekends. But, trading takes work for a lot of people. Yes, I know there's going to be some people, there's that small, minute percentage where things just come naturally to them, almost like, like for sports stars, they just have a natural talent for it. But in general, the vast, overwhelming majority of traders, they got to work at it. And there's no shame in working at it and trying to learn. And that's what I like to do these presentations for, is because I want you to open your eyes to new ideas, and hopefully, you can take that and make some money with it. So the first thing I'll talk about is what is price rejection and how to profit from it. So, I call it the number one reason why traders fail. Okay, but I've got several number one reasons actually, but one of the main reasons, if not the number one reason traders fail, is they think all prices are created equal. And this goes back to indicator-based, price-based trading. Most people, when they come to trading, they throw a bunch of indicators on the screen and they go from there. And an indicator basically takes, the traded price and puts it into a formula and comes out with something. But not all prices are created equally. Not all prices are the same. And this is especially true when markets make highs or lows. Let me just give you an example. If you think the market hits a high and trades 3 contracts and then sells off, versus a market that makes a high and trades 3,000 contracts and then sells off, it has different meanings. Okay, if it trades a new high and trades 60 contracts, comes off, that's going to be different than if you trade a high and 3,000 contracts, traded at the high and then comes off. It can be a sign of resistance. It could be a sign of, just the market pausing and then it's going to go back up, or it could be a sign of, lack of buyers. So it's got different meanings. And, we've got to realize, right, the market exists to facilitate trade. It's going to find price levels where both buyers and sellers can trade and be happy. In other words, it's looking for a fair price. That's what the market is doing. It's looking for a price where traders are happy to transact at a price level. So in order to find this fair price level, the market's going to go up and go down. All right, it's going to find a fair price level. It's going to trade there. Then the market's going to move. Perception of value is going to change. And then the market's going to find a new fair price level. That's what makes the market go up and down. And market will move up and up as traders buy and buy. However, as the market reaches its high price level, the level where traders think it's too expensive to buy, then buying activity becomes less. Right? Selling will start to take over and the market starts to drop. And the opposite is true when the market is moving lower and lower as traders sell and sell. The market reaches the point where prices are just too cheap to sell anymore, and selling activity becomes less and less. Buying takes over and the market starts to rally. Give you an example. Okay, say you have winter jackets, okay? And you bought a bunch of winter jackets thinking, hey, it's going to be cold this winter, so I'm going to buy these jackets and I can sell them for a high price. Well, the winter's mild. All of a sudden you're sitting in mid-January with a boatload, a truckload of winter jackets, and you're going to say, well, I got to get my money back. So you start selling them and you start lowering the price, and people are buying them, okay? But as you lower the price, you start thinking, hey, you know what? I'm losing too much money. So you start, you want to recover back some, so you sell less and less. And then finally, you're like, hey, it's just too cheap. I'm just going to hold these, put them in storage. The next year I could sell them at a higher price, okay? That's where, that's in a market that's selling off. Now, think about, a support level. And a good example of this is, you got a paper towel, you hold it under a sink, right? You turn on the sink, the water is running, and it's a constant, think of the water as the selling pressure. It's a constant. You're holding the paper towel. Well, eventually it's going to break through that support and it's going to keep going down. Now, if you're holding the paper towel there, but instead of, having a constant stream of water coming down, you slowly turn off the water, where it's just coming down instead of a constant stream, it's just drip, drip, drip. Well, that level, that paper towel is going to hold. Why? Is because the selling pressure, which was the water going down, is becoming lesser. Okay, and if it's becoming lesser, if selling pressure is going to become lesser and eventually dry up, then theoretically the market is going to rally. So, most people, when they search price rejection on the internet, they find a chart like this, and like here, the guy has a swing level, right? That's the line, horizontal line going across. Then he's got, the candlestick chart where, it's kind of a shooting star here where it shoots up through the level, comes back down, and these internet analysts will say, well, that's a price rejection, because we have a level here and price rejected that level. Well, you don't know why that price is rejecting that level. Is it price rejection because there's no more interest in the market going higher? Or is it price rejection because there's a lot of resistance up here? I mean, there could be a big seller here whacking it, just sitting here waiting to, hit the sell button when people start bidding it up. Whereas it's going to have a different meaning if it breaks through there and the buying gets lesser and lesser, and finally the buying stops and it starts drying down. Because if this is a resistance level, and you break up through there and you got a big seller sitting up here, ready to hit the sell button, well, what's going to happen when he sells? Okay, the market comes off, but if you come back up, people test it again, he sells some more, comes off a little bit. The third time you come back up, and he's only got a little bit left to sell. And then finally the buyers realize that and they start buying it up, and all of a sudden that seller is no longer there. The market's going to rally. Okay, but if it's coming up into this area and you just have your normal order flow, for example, but buying isn't as strong anymore. So say 50 contracts are bought on the offer, then 20, then 10, and then 5. And then that's it. The last buyer has bought, the market's going to reverse and go down because you don't have that buying pressure anymore. So, there's different ways to look at this. And unless you're looking at the volume, you're not going to know. So you got to remember, right? No market can move in one direction forever. At some point, it's going to become too expensive or too cheap. And at some point, price rejection appears. Traders have basically taken a stance and said, it's too expensive or too cheap. Candlesticks, okay? When candlesticks came out, well, they didn't come out in the 90s, but when they became popular in America in the early 90s, I jumped all over them. I'm a visual person. I'm someone that believes the mind can process images at a much faster rate than text or numbers. And there's certain candlesticks that under candlestick analysis are price rejection candles. You got your hammers, you got your shooting stars, you got dojis to some people, but oftentimes you see the charts like this where they circle it. Well, you have a shooting star up here. Why haven't they circled this one that failed? This one is borderline, but they still have it circled. Okay, but then they'll say, well, we come down here, we tested these two levels, and both times it rejected these levels. Well, why did it reject those levels? Is it because there's a strong buyer down here? That every time the market tries to push down here, buyers come back out and buy it up? Well, that's not price rejection, that's price support. Okay, but if you come down in here and the selling is weaker the second time, that's a sign of price rejection, and then the market goes up. Now, I know some people are going to say, well, I don't really give a shit if it's price rejection or price support. All I care is if it's going to touch this level and rally. Well, okay, good on you, good luck, and I hope you're successful, because I'm more of a purist in the sense that I want to understand what's happening in the market and make the proper trading decision based on it. Because if I know there's support here and we're going to come down in here, I'm going to be watching. Okay, I'm not going to automatically think that we're going to hit the support level and rally back up. If I see we hit the support level, rally up, come back down, selling's a little weaker, and then we come back down again, selling is weaker here, then yeah, I'm going to think it's going to rally. But if I come back down and I see selling is strong and looks like we're going to take out this support level, I'm not going to think the market's going to rally. Instead, I'm going to think the market's going to sell off. So price rejection is a difficult concept for some people to understand because they don't look at volume, right? They just look at a normal bar chart and they treat every price level that's traded as the same. They don't take into account volume. But the way to understand it, I always say, is you got to put the market activity into what you do in your everyday life. In the grocery store when you're shopping for groceries, in the jewelry store, if you're buying something nice for yourself or for your wife, and even in dating, right? You remember there's always a story of the prettiest girl in school doesn't always get asked out to the dance because she's too pretty. So people get, rejected before they even get rejected. They psychologically, they think, well, she's not going to say yes to me because she probably already has a date, so they don't ask. You go to a jewelry store, you want to buy a fancy diamond ring or something that's worth $100,000. Well, majority of buyers are going to reject it. One, it's too expensive for them. They just don't have the money. And, for the maybe handful of people that can afford a $100,000 diamond ring, they'll look at it and, yeah, it's probably just a little bit too expensive, more than I want to pay, so they're not going to do it. They're not going to pay for it. So as you go up that triangle of available buyers, it gets lesser and lesser. So people are rejecting those higher prices. Grocery store, the same thing. If you have choices with grocery stores, you can go to Walmart, you can go to Meijer, you can go to Target, you can go to Jewel, or whatever your local grocery store is, and sometimes they have the same thing, but it's got different prices. Well, you're not going to buy like the watermelon at Meijer if it's $5 for one watermelon, but you might be interested to buy it if it's at Walmart for $3. You're going to reject the higher price. So that happens all the time, even in grocery stores. You don't realize it, but what you're doing, people say you're shopping around, but what you're doing is actually rejecting the higher priced items for where you can get it for a lower price. And price rejection is a fundamental aspect of the market that's overlooked by many traders because they can't define it. And like I said, with order flow, you can define it. It's because you're looking at the volume. Otherwise, you're just guessing. That's why people don't really talk about price rejection. All everyone likes to talk about is support and resistance, because it's easy to draw a line on a chart where the market has touched 2 or 3 times and say, well, this is support and this is resistance, when sometimes it's not. And like I said, some people are going to say, I don't care. All I care about is if the market hit there 2 or 3 times. That's I'm going to take a trade based off of it. But what I'm trying to say, the point I'm trying to make is you can make a better trading decision if you just take a second to look at the volume that's going through there. Is it lighter than normal, or is it consistent with normal trading that's going on? If it's consistent with normal trading that's going on, not all support or all resistance is going to hold. It's not an infinite thing where every time we come down to that price level, it's going to hold forever. No, at some point it's going to break through. So if we're trading average to above average volume, when you test the support or resistance level, the second, third, or even fourth time, eventually you're going to get through that level. But if you test that level the second or third time and the volume is a lot lighter, the selling pressure is a lot lighter, if you're coming into a support area, there's a very good chance that the market's going to bounce up off that level. It's not going to break through it because the selling pressure is just not there to move it through that support level. So when you're able to identify when prices are being rejected, you can position yourself in the direction of the ensuing move. And price rejection often occurs at market highs or market lows, and more importantly, price rejection can also appear just after a high or just after a low is made. And we'll get into another aspect of it is to see it in a move. Also, it happens in a move. As the market is moving in a direction, you see signs in the volume that it's rejecting lower prices if a market is moving up, or if a market's moving down, you can see there's times where it's rejecting the higher prices when it tries to come back. So if you can determine a higher low is being made, that's going to present you a great trading opportunity to catch a potential big move. That's what we all want to do. We want to catch big moves. So price rejection as moves start. So this is the euro currency, and this is a 5-minute chart. And you can see down here where this arrow is, there's signs of price rejection in the order flow. That's the, and right before the market put in this big move up to new highs, from 143.30, 32, all the way up to, 114.68. Here's another example. This is also the euro currency. You got your swing high up here, signs of price rejection. Then you start coming off. You got 2 more signs of price rejection on the way down. So say you're not convinced yet. You know what, Mike, you're crazy. I don't think that's price rejection up there. Then what happens? On the move down, you sort of hit this area where you start going sideways, but at the tops of these bars, you're seeing some signs of price rejection, and then the market sells off. And again, just after the high is made, you hit your high up here, then the next bar, it tries to circle back up there, maybe make a run at that high to take it out, but you're seeing signs of price rejection, and then the market just sells off from there. So price rejection, what is it? It's when high prices are rejected by buyers as being too expensive, and buyers don't want to overpay for something. No one wants to overpay for something, whether it's in real life or whether it's in trading in the markets. And low prices are rejected by sellers as being too cheap, and sellers don't want to sell at such low prices. Again, think of it in real life terms. If you're trying to sell something, right? Say you want to sell your used desk, on Facebook. This Facebook Markets is a great place to buy stuff that's used, and it's a great example. You want to sell your used desk on there, and you think it's worth $100. You put it up there, nobody wants to buy it. And maybe some guy comes in, well, I'll give you $20 for it. Well, you're not going to sell it to him because you think that's too cheap. And that's a microcosm of the whole bid. The bid ask market right there. You may say 80 and go back and forth with him, but maybe you got no interest. Maybe nobody even comes in and is interested in your desk because they think, oh, it's too expensive, I don't want to buy it, so no one bids. And you lower it to 80, still nothing. Like, well, what do I do now? Do I sell it at $50? Or do you think, you know what, for $50 I'm better off just keeping it? That's price rejection on the downside, right? If say you collect baseball cards, and there's a card that you want, but it's very expensive. You're not going to buy it because it's too expensive. You're going to wait for it to come down before you come in and start buying it. So price rejection. The second thing I want to talk about with price rejection is why price rejection allows you to catch trends when they begin. And every trader has access to the same information. I always say this. It's how you use the information that makes the difference. And honestly, this information, the information in the order flow volume footprint chart, is information everyone has access to. You don't need level 2, level 3 data. You just need your regular data feed from the exchange, which goes through your broker, or through Kinetic, or through IQ feed, or whoever data feed you're using. It comes with the basic subscription. You don't need level 2. You don't need to pay extra for that. And so it boggles my mind sometimes why people don't use this information. And instead of trying to guess the future direction of the market, you just listen and see what the market is telling you the direction is going to be, and you trade it. It's like, the best. There's a scene in I forgot what it was, one of those, not Iron Man movie, one of those Avengers movies, or Captain America, Thor comes in, and then you have Iron Man there, and Iron Man gets all upset because Thor took his brother Loki. But so Captain America says to Iron Man, well, what's your plan of attack? He says, well, that's my plan, attack. And it's like, what's your trading plan? Well, my plan is to trade. Rather than sit around, wait for confirmation, I'm trying to try and wait or guess the future direction because I got a certain pattern for me. No, you got to trade. I mean, that's what traders do. Firms don't hire traders to sit around and wait for confirmation or wait for trades. They hire traders to trade and make money for them. And, when it comes to trend trading, we've all heard these sayings, the trend is your friend. Trade in the direction of the trend, let your winners run. We've all heard those and more. And those are solid pieces of information. I admit, I subscribe to those sayings as well. I'm not here to dispel those. I mean, those are common basic tenets of trading. Got to trade in the direction of the trend, and you got to let your winners run. Cut your losers and let your winners run. And that's where price rejection can help you. If the trend is your friend, well, you want to get in on the trend as early as possible, right? You don't want to necessarily wait for confirmation and give up extra ticks or extra pips in the market. You want to get in as soon as there's signs of price rejection. You can see this low here, you got signs of price rejection. This high, signs of price rejection. You don't need to wait, well, I'm going to wait for a double bottom to form or a double top to form to get short. No, I know there's at this high up here, there's price rejection. I'm going to get short. I know there's price rejection at this low. I'm going to get long. And then in the direction of the trend, say I'm long from this low. If I get a sign in here that, hey, even though it's starting to sell off, they're still rejecting these lower prices. You can ride this for more. So how do you catch a trend early? Well, you have to identify a market inflection point. A point where prices are being rejected as too cheap or too expensive. And again, you want to get in at ASAP, as soon as possible. And one of the ways is single prints. single prints is an easy way to see price rejection in a bar, and it's used when taken in context of the market in whole. Okay, and what is a single print? A single print occurs when the last buyers have bought at a high or the last sellers have sold at the low. And this was a piece of advice that I got from Tom DeMark, one of the great market analysts. I think in the last 30 years that probably doesn't get as much recognition as he should, because he actually deals more on the institutional side. But he told me that when the last buyer has bought, the market's going to not go higher anymore. When the last seller has sold, the market's not going to sell off anymore. And you have to realize these areas of price rejection, or some people refer to them as price exhaustion. Orderflow Analytics copied this. I released this in 2015 in the first version of my Orderflows Trader software. And now the most recent release of Orderflow Analytics, they've added it in there. They call it single print exhaustion. I usually just refer to it as single print, but I also refer to it as rejection. And what we do is we draw on the Orderflows Trader software, we draw a box around the single print on the down candle on the red bar. It'll appear on the top. On a green candle, it'll be a green box at the bottom of the bar. Now, when I said, you take it in context of the market, don't just think, well, I got a single print, I got to get short or I got to get long. Take the overall market context, okay? And what do you have here? You got a market that's rallying. You got some single prints, price rejection. Okay, you come back up and make a new high. At that new high, you got single print. As you start coming off, single print, single print, single print. Now, this is interesting too, because people always ask me, Mike, I have my own way of market analysis. How can I use Orderflow, or what piece of Orderflow can I use to complement that? Because what they want to do is they want to refine their entries, refine their exits. Maybe they have a way of finding support and resistance. Maybe they use fib numbers. Maybe they get pivot levels from someone, and really what they want to look for is better entries or better exits. And how can they use it? And I often say, start with single prints and see how price reacts around a resistance level. If you have a resistance level up here and you're seeing single print, single print, single print, single print all right around that resistance level, you could be fairly confident in getting short. Yeah, you're gonna say, well, the market popped up here. Well, sometimes when you're trading a level and the market's rallying, it doesn't turn around right at the level. It oftentimes can overshoot that level just a touch. That's why it's called, a support and resistance level, not a support and resistance price. But single prints are great in that respect. Price rejection as being too cheap. This sort of goes to what I was saying about using it in the direction of the trend. I'm going to talk about this more in a minute. Is as the market's moving up, every time we sort of come down here, go sideways, you got to sign a price rejection, and the market makes another. Higher highs, then you start going sideways, boom, a single print, price rejection down here, and the market is rejecting these lower prices as it tests it to try and go lower. It's not going lower, and then the market keeps going on up in that direction. So how do you trade in the direction of the trend? Is you go with the momentum of the market. And there are signs of price rejection as a move is underway. And think of it like a boat, right? When you're driving a boat, there's no brakes on a boat. You just don't stop the boat. It still has forward momentum. But if you just kill the engine a little bit, and you slow down, you might be, you're still making a wake, if you understand boating. You're still going forward, but you're sort of rejecting I don't know how to say it. It's not the best example, but, trends move with momentum, okay? And oftentimes, as the market keeps moving in that direction, it's got momentum, and you can see signs, little trails, little breadcrumbs, so to speak, of price rejection in that move. And the good thing is, when you see those signs of price rejection, that's your confirmation that you're on the right side of the trade. When I say confirmation, you're not waiting for it. You're in the trade already, and this just reassures you that you're on the right side of the trend. Lots of times we get into trades and we think we're on the right side, but we're actually not. If you're long here and you see these signs of price rejection, hey, that's great. If you're short, right? Say you say, hey, you know what, I think this is a swing high, you get short. Okay, I got a sign of price rejection here, a bearish sign. But then you run into this and the market starts turning around and you're like, well, you know, I'm going to hold it a little bit. No, you get out because the signs are no longer there. But if you're long, you know, from down below, you know, before this chart started, and you come in here, you're like, well, maybe should I get in? Should I stay in? Should I stay out? Get out? When you see a sign of price rejection there, that's reassuring you, okay, stay long. As you start going up, okay, you can stay long as you keep going higher. Again, another example, you know, you got your single print down here at the low. You start rallying, okay, hey, I got a single print, that's good. I got another single print here. You know, as we hit this this first down bar, right, you're going up, you're thinking, oh my gosh, we're going to sell off, I better get out. But then you look, okay, I could see in the volume, I got a single print there. Okay, that's reassuring, I can stay in. And then, you know, you see some other things in the order flow. You see a prominent point of control, you see a stacked imbalance, and the market starts continuing on back up. And then you even got another single print here, another single print there, just to confirm that, you know what, you're on the right side, you're going in the right direction. You know, if you're getting short off this, oh my gosh, I got a double top here, I better get short. Well, then you run into the single print here, that's probably not a good short. But, you know, a lot of people say, well, you got to look left and say, okay, well, I came up here, we tested this double top, so we're going to sell off. Well, no, is what I'm telling you. Because down here at these lower levels, price is being rejected. Price rejection, single prints in a trend, same thing. Right off the low. This is the low bar here. You have a divergence. Single print. As you come up here, start going sideways, single print, and make new highs. So, how to see price rejection using order flow? Well, you know, that's what most people here on this presentation for, is because they want to see how they can use order flow to see price rejection. And there's the hard way and there's the easy way. What's the hard way is you can take years by sitting in front of a trading screen and watching the market day in, day out without blowing your brains out or throwing your computer out the window, because trading is boring, honestly. If you got to sit in front of a trading screen and you're not making any money doing it, you're going to lose interest. You know, you're going to start, mind's going to start wandering, go to Facebook, go to whatever, you know, Google or Drudge, and your attention's not going to be there. Now, the easy way is to use software that is going to do the analysis for you. Now, the Orderflows Trader software, which I developed, has several tools that's going to highlight price rejection. And I talked briefly just earlier on single prints, but there's more advanced tools out there. The Orderflows Ratio and Price Rejector software add-on. Now, I told you about single prints finally being adopted by some of the other software vendors out there, like Orderflow Analytics. Now, the ratios also, when I released the original version of Orderflows Trader in 2015, the ratios were something that I was the only one using, because I was the only one. I don't say I invented it, but you know, maybe some other guy somewhere around the world has invented it, and you know, a couple years before me, and never told anyone. But I was actually doing this analysis in my head or on a calculator when you know, the math, you know, was not too difficult, but you know, then the numbers were big that it's not as easy for me to figure out. But I had the ratios and the single prints in 2015 in the first version of Orderflows Trader. We've since done an upgrade to the Orderflows Trader earlier this year, where we've added in a few more indicators to help you use in analyzing the order flow. And the Orderflows ratio were also, you know, copied by a lot of other people, and you know, I don't mind people copying my ideas and putting them out there, but you know, some people are cool about it. You know, they give me name recognition. You know, I don't need monetary recognition per se, but you know, say, hey, you know, this is the concept first put forth by Mike at Orderflows. But you know, it just kills me sometimes when people take this idea, then they try to package it up into something fancy, like, oh, this is our order flow volume delta algo and things like that, or the order flow volume ratio algo. You know, they think that if they throw in the word algo, people, oh, it's an algo, I better buy it. You know, you should really just learn how to trade rather than just go buy shiny objects out there. And the Price Rejector software is an additional software that it runs also on NinjaTrader. It'll run on a normal bar chart, but it reads the order flow. It doesn't deal with the ratios. It reads a different part of the order flow to find price rejection. You know, it deals with order flow, imbalances, and price action. So it's a further step in order flow analysis. So again, just briefly, a single print occurs when there's a single volume print, volume between 0 and 9 contracts at the bottom bid side of a green candle, which indicates sellers in that bar have dried up as the market was moving lower. This is a bullish single print. The opposite is true for bearish single print. The top offer side has a volume between 0 and 9 at the top offer side. This indicates that buyers were starting to dry up. There's people have lost interest in buying, basically. And again, it's going to show, on the software when you load the template, it's going to take the information that's available to everybody, right? You don't need level 2 or level 3 information, just your normal data feed with bid-ask data. If you're using interactive brokers, it's not really recommended because their data, the way it's sort of aggregated on a time basis rather than as trades occur. So single prints, all the information, all the bid-ask, what's traded on the bid and what's traded on the ask is taken, and the software takes it and puts it into a nice, easy to read format, So you could see single prints, you could see other things in there, but what I'm talking about right now is single prints. So I'm showing you single print, single print, single print, single print, single print here, as the market's moving higher. Now, the next thing I'll talk about is the ratios. And this is a prop tool that I created to help me see where price rejection or support appears in the order flow. And ratios measure the order flow occurring in a bar. Depending on the ratio, it can mean price support or it can mean price rejection. And in this presentation, I'm going to just talk about the ratios that indicate price rejection. And every bar is going to have a ratio, okay? And some indicate price rejection, some indicate price supports. The ratios that have no bearing one way or the other, which is actually the majority of ratios on the chart, is your normal order flow, right? Markets exist to facilitate trade. That's why markets were invented, so people can trade with each other and transfer the risk. And again, when I see people putting out, copying some of my ideas, they don't explain it fully, so you don't really understand what you're looking at. And when you get my software, I explain it so you know what you're looking at and can understand and make a good decision. So there's different types of ratios. There's a big number ratio and there's a small number ratio, and each one has a different meaning. So they're either going to be blue or black. Black ratios, they appear above the red candle or below a green candle. It's just your normal order flow. There's nothing special about that bar in the order flow. But blue numbers above a red candle or blue numbers below a green candle, green is a bullish ratio. A blue number below a green candle is a bullish ratio. A blue number above a red candle is a bearish ratio. And you can see how oftentimes the markets turn at a bar with a blue number, blue number, blue number. Now here, no, here, no. But that's information in the order flow to help you catch these market turning points. Okay, like I said, sometimes the market has got black numbers, right? That's just the normal order flow that's going through, just your normal trade being facilitated. But there's times in the order flow that things are very obvious, and that's what we try to highlight to you with the ratios. And as you can see here, right, bullish ratio, the market's going up. Bearish ratio, the market's going down. Bearish ratio, the market goes down. Market's going back up. You got a bullish ratio. Price rejection, again, you got a high up here. You got a divergence. So you got a new high with negative delta. That's what a divergence is. Start coming off, but then you go sideways in here. Well, at this point, you're thinking, well, what are we going to do? We're going to go back up, test that high, or we're going to sell off? As a trader, you got to make these decisions. Some people will say, well, I'm going to wait for confirmation. I'm going to wait for the market to come back up here, then sell off, or see if we reject that price, etc. Well, you don't need to. You can trade, right? You can see you got price rejection, price rejection, price rejection in the ratios. And what happens? Eventually, the market sells off. This is a move from the 2867 area all the way down to 2857 area in the S&Ps. Okay, again, watch the ratios. Watch where they appear. Here you got your bullish ratio. Market goes up. Well, we could even take it back here from the beginning here, infinity. Well, don't worry about that one for now. But, okay, so you got a bearish ratio, market's just going sideways, and you got a bullish ratio, the market goes up, bearish ratio, market comes down, Bullish ratio, market goes back up. Bearish ratio is the market starts selling off. Again, I'm not trying to say it's a red light, green light system, but it helps you analyze the market so you can be on the right side of the market. Okay, bunds, great market to trade. You know, people always ask me, hey, you know, what's the market I can trade? I got a full-time job, but I want to watch the market. Well, wake up in the morning and trade bunds. It's a great contract. Trades on Eurex. It starts at 1 a.m. Chicago time, and at 2 a.m. is the cash open. So liquidity really starts to pick up after 2 a.m. But you know, you can trade it from 2 a.m. until 6 a.m. if you go to work. And you can see here, bearish ratio, bearish ratio, bearish ratio, bearish ratio, price rejection are these three right here. So you know, as you hit this high, you got signs of price rejection, and the market just sells off naturally. So, you know, these are the ratios that are in the Orderflows Trader software. So what if you can't read order flow? What if you don't want to read order flow? People, Mike, you know, I don't have time to read order flow. I mean, gosh, it's so many numbers. I don't like numbers. I'm math phobic, number phobic. What can you do for me? Well, that's where this tool, the price rejector, comes in handy, and it analyzes the order flow, imbalances, and price action. And it works. The great thing is it works on a normal bar chart as well as a volume footprint chart. So this is the price rejector, right? Oh, this is a normal bar chart, okay? And when you lay the price rejector on top of it, voila, you see signs of price rejection, signs of price rejection, signs of price rejections, signs of price rejection. Now people say, well, it doesn't unpick every single high and low. Well, of course not. I mean, come on. It's reading the order flow. It's looking for signs of price rejection in the order flow. Not every bar is going to exhibit price rejection. There are points in time when it is exhibited in the order flow, and those are the times that you got to take advantage of it. And a perfect example is, you know, people like, take for example this high here, okay, where you have the price rejector kicking in here, right? It comes back up here. You know, I know a lot of people will say, well, I got to get short here. Well, okay, the first time you traded there, you have signs of price rejection, and then you sold off to an area where you got signs of price rejection down here. Now as you come back up, you got to watch, are we getting lesser and lesser? I mean, you can put an offer in here to try and get the ensuing double, you know, swing double top and sell off. But if you're watching the order flow, you're watching the volume, and you see the volume is heavier now than it was earlier, there's a good chance that it's going to get through there and keep going higher. Because like I said, you know, we rejected these prices earlier. Buyers rejected these prices. Okay, you don't necessarily know if there was strong sellers there. But if you're coming back up here and buyers are no longer rejecting those prices, things have changed in the market and we can keep going higher. Again, you know, this is the price rejector again on NASDAQ. You know, it gets some nice moves in here. The euro currency. And again, you know, you got to watch, you know, when you test these levels again, you know, is buying still strong or is buying weaker? Or selling, is it strong or is it weak? You know, there's more than one ways to approach the market. You know, everyone always says, well, I have a method of trading the market. You know, when it works great. When it doesn't work, it doesn't work. Well, you need more than one way. You know, you got to diversify, so to speak, rather than just have one way. I mean, there's, you know, if you have a store, right, selling phone chargers, well, you're not going to just sell an Apple charger. You know, you got to add, you know, Android chargers. You got to add some of these stupid, not say stupid, you know, add some of these little Chinese phones that have, you know, their different chargers. Even Nokia's got a different charger. So you got to diversify. You got to add different product lines. And with trading, you got to have different different ways of analyzing the market, different trade setups. This is how it looks on a volume footprint chart. You know, you got the swing high, you got the price rejector right after the stacked buying imbalance. You know, a lot of people say, oh, I got stacked buying imbalance, I got to buy. But, okay, if you're watching the order flow and you have a tool like the price rejector, you can see, well, you know, prices are being rejected up here. Okay, so if I'm long, yeah, I'd be very hesitant, and instead I'd be looking to cut my loss as soon as possible rather than letting myself get stopped out at a lower price. Then down here, you got some signs of price rejection. The first time you hit this low, second time again, you know, you're still seeing some price rejection in this bar, even though you made a new low. Okay, maybe you took a trade here, you got stopped out, but then, okay, well, you know what? I still see price rejection. Sometimes that's how the market does. It doesn't automatically just turn on a dime. Sometimes it makes that one or two last little poke through before it turns around and puts in the monster rally. So even if you got stopped out here, you still got to take your trade. This is the problem that I see with a lot of traders is they have a loss. Okay, say they take this trade here, they have a loss, and it's like all of a sudden now they're going to handicap their trading system. They say, well, I had a loss, so I'm going to wait for the next trade to be a winner before I get in. Well, then what you're doing is you're hindering yourself. You're affecting your performance because you're not going to take this next trade because you just suffered a loss psychologically. That comes down to the mental side of trading. But a lot of traders say, I had this loss. I don't know if I trust this method of trading. And then what happens is they don't take the next trade, and this is what it looks like. That's why you got to have a trading plan where you can define now how much you're going to risk on a trade and how many losers you can withstand. And if it's too much for you to withstand, you got to redraw your trading plan. So hopefully by now you can see how powerful order flow analysis is in determining price rejection. Again, don't overcomplicate trading. People like to overcomplicate things. That's human nature, whether it's in trading or whether it's in real life. And hopefully if you found this helpful, you'll really like my Orderflows Trader 2.0 software package. And what it is, it consists of the Orderflows Trader 2.0 for NT8, NinjaTrader 8. It works on NinjaTrader 8. It's the volume footprint chart with 7 pre-programmed order flow indicators already in there. People, they like to keep selling you new indicators. I don't like to necessarily, even though I have additional indicators, I feel it's complementary for it. That's not the whole core where I say, here's the volume footprint chart. Now you got to buy all these different 7 indicators. That's why I put these tools in there so that you already have tools that you can use in your trading. And you're going to get my chart template so your charts will look like this. All right. I don't want you to sit here and staring at a blank screen thinking, oh gosh, what do I got to do? How do I set this up? It doesn't make sense. And then you're going to, like I said, we're not all born in the matrix. We don't have chips implanted in our head that we can figure out everything there is about computing. That's why I throw my chart template in there so you can get your chart to look like mine in a few clicks. Literally, you just click, copy and paste it into the chart folder. And normally I sell this software by itself for $8.99. But I realize that having order flow software is one thing, right? You got to know how to use it. And that's what bothers me a lot about, software vendors. It's a slimy business, honestly, because people take other people's ideas, put them out as their own, and they don't understand how to use them in the first place. And then it just, it's misinformation, fake news in the trading world, so to speak. Fake information is what I call it. So I give you additional education, right? I want you to understand order flow. I want you to learn how to trade order flow. I don't want to just give you a fish. I want to teach you how to fish. And so what I got is for you is if you buy the software, I give you access to the order flow trading course. And I sell this normally for $300, $297. It's 15 hours of video instruction. And it really covers all the bases of learning order flow. Okay, and people buy this regularly. I mean, especially people that have other trading software, people that use Sierra charts, people that use NOFT, people that use OFA and some of these other, GOMI, that they want to learn order flow. They see it, they're like, I'm interested, but it's so freaking complicated. I can't get my head around it sometimes, but I know there's value in it. They get the course, and then, they're able to understand it better. So I'm going to give you access to that for free. But again, I know that you're watching this webinar is because you're really interested in furthering your knowledge in order flow. So I'm going to also give you access to my Order Flow Inner Circle video series. There's 56 videos on advanced order flow. I don't want to call them tricks, but forms of analysis, tips on trading that you're not going to get anywhere else. This is proprietary information. I created this Inner Circle video series actually for my kids because they're still young. My eldest is turning 6 this year, and if they want to learn how to trade, if anything happens for me or whatever, suffer a stroke or something, at least they'll have this information that they can go on to watch and learn, and go from there if they want to learn how to trade. Hopefully I'll be able to sit down with them and teach them. But right now they're more interested in watching Peppa Pig videos on YouTube than watching videos on the market. But hopefully, in time, this is there for them to learn how to trade as well. So, and it's also for you, so you can learn how to trade. That's why I created these videos, is to expand the knowledge base that's out there. So, you add up the software, the training, the inner circle video, that's 1693 already. It's 1693. But, even because Investor Inspiration always invites me back, and I really appreciate the chance to speak with people. It's great because I've made some good friendships with people, honestly, that I've met through these webinars. I'm going to give access to the Trader Kickstart training, which deals with the mental side of trading. It deals with the psychology of trading. We don't understand our own selves. People always say you got to do research on the market. You also have to do me search. You have to look inwards and see where your strengths are, where your weaknesses are, and develop those. And sometimes it's not so much as taking the parts that don't work in your trading and just disregarding them. You also have to take the parts that do work and go take it a step further from there. So I'll give you access to that. Normally I sell that for $297. So you start adding that up, it's almost $2,000. It's $1,990. But you're not going to pay that. You're not going to pay anywhere near that. You're just going to pay a one-time payment of $899. So you go to orderflows.com/PR, and it'll take you to the page where you can sign up. There's no more monthly payments. I'm not going to shake you down in a year and say, oh, you got to pay another yearly fee. No, that's it. It's $899. And you're going to also, for the next 3 traders, they're going to get the price rejector tool, the additional software that runs on the NinjaTrader platform. So you could put it on there so you could see these areas of price rejections in the bars. Whether you use a bar chart or whether, I believe it's better for you as a trader to use a volume footprint chart, but you're going to get that for free. So, you're going to have another way to increase your success in trading. And again, you add all that up, that's, $2,290, but you're not going to pay that. Again, you're just going to pay $899. And, other people have said to me, they've posted these online, Mike, your Orderflows Trader software is remarkably helpful because I can clearly see now what's really happening in the market. Like, for example, who's in control of the market on a very specific time and who's getting weaker as well. I love the idea of your ratios printed above or at the bottom of the bar to gauge if price is rejected or defended. There's other people saying nice things about the software, if you take the time to learn it. Again, it's not something that if you think you're just going to install it on your system and not understand what you're seeing, or rather not take the time to read one of the user guides, because I also give you guides on how to setups to look for or what things mean in the market. I mean, you do have to take some initiative on yourself. You have to want to learn. Honestly, if you just want somebody, if you're just going to be the type that's going to buy it, sit back and think, okay, computer, start spitting out money. No, it's not going to do that. And, save yourself the time and energy. Don't buy the software. But if you really want to learn how to trade, I suggest you buy the software. And, one of the things I haven't even talked about in here, but we have a weekly live group training session. It's live. It's like this webinar. Well, this webinar is also recorded. The weekly training sessions are also recorded if you're not able to attend, like say you're in Europe. But it's held every Monday night, 7 p.m. Central Time. And I get on a call with screen sharing, and you're free to ask questions. If you have a problem setting up your chart, I can answer those questions there. If you got a question about, who's a good broker, whatever, anything related to the markets, you can ask and I'll answer. Say, hey, Mike, what should I look for in Delta? I'll tell you. What should I look for in imbalances? I'll tell you. What's a good chart type to use? I'll tell you. That's what it's there for. It's for you to ask questions to me, and I'm there every week, so you know where I am. So you can't say, "Oh, Mike, I can't reach you. I sent you an email. I can't reach you." That's where I am. I'm live there. You can talk to me live. What other software does that? What other software offers that? So what you do is you go to orderflows.com/pr.html. It takes you to this page. Scroll down here, and you can see here you get the Orderflows Trader 2.0 for $899, the trading course, the Inner Circle video series, access to the Trader Kickstart as well. And for the next 3 traders, Then you get the price rejector indicator for NT8. Again, I'm going to take this down when the 3 traders have signed up. So if you still see it, you still got a chance to get it. You just click buy now. I want this. You have to want it. In life, when you want something, you got to take action. It takes you to PayPal. I don't get your credit card information. I don't want your credit card information. Rather, it's through the third party. Most people are familiar with PayPal. If you ever bought anything online, you probably use PayPal. Most people have a PayPal account. Just make sure your PayPal email address is current, because that's where the information after you buy will be sent to. Some people like to buy something through PayPal on an email address that they don't use anymore. Then they complain that they haven't gotten it. It was because you haven't checked your PayPal email address. I don't know that your PayPal email address is different than your normal email address. So please make sure you're using your correct email address. So go to orderflows.com/PR. And again, why should you join Orderflows is because you can see the power of order flow analysis and how it can change your trading. You want to understand what's happening in the markets. You're excited to find low-risk trading opportunities, and most importantly, you want a life of freedom and fulfillment. That's why people come to trading, is because they want freedom. They don't want to necessarily be chained to a desk all day long. They want fulfillment. They want time to be able to spend with their family. Honestly, I had a good life working in the corporate world, but I didn't have the freedom. I didn't have the fulfillment. Fortunately, it was just ironic that I was in the trading industry, and yeah, I made a decent living. I was able to, travel the world and do things that a lot of people just aren't, but I didn't have that freedom because I was sort of chained. It wasn't until I left the corporate world and was trading for myself that I realized what sort of freedom I have. I've got 3 kids now, and being able to spend time with them as they're growing up, send them to school, go on vacation with them is fantastic. Just a simple taking them to the Menards shop, to buy something for the house is special to me. So I hope you can see how trading can give you that freedom. And again, like I said, it's not like some people say, oh, Mike's out there to scam your money. No, I'm not. I really want you to help you learn how to trade and become successful in trading. That's why I do the weekly live group training sessions, so you could have access to me on a weekly basis and ask your questions. And I really enjoy it, honestly. I get people sending me emails now sending me in their charts during the week saying, hey, this is what I picked up in your weekly session, and show me some of the setups and trades that they've taken that were successful. So act now. Go to orderflows.com/PR and join. So again, I can't stress this enough. Stop flushing your money down the toilet. People think they got to buy everything on trading. No, you just got to be selective in what you buy. Buy things that you think are going to help you in trading. So again, go now to orderflows.com/PR. So thanks everyone. Have a great weekend. And hope to see you guys on the inside and see you there in our weekly live group training session for members on Monday night. So bye-bye.